6 things you should know when buying and selling foreign exchanges. Examine the exchange rates for the currency you want to buy based on the currency you want to sell. Currency exchange rates are quoted in pairs. The exchange quotes to tell you how many units of currency you'll receive based on the currency you want to sell. For an example, a USD Euro quote of 0.91 means that you'll receive 0.91 euro cents for the US dollar. The value of currencies frequently fluctuates. Anything from political instability to a natural disaster may cause a fluctuation. Make sure you understand the ratios between currencies that are constantly changing. Develop a trading strategy. To make a profit on your transaction, aim to buy a currency that you expect will increase in value, which is known as base currency, and currency that you expect to decrease in value, known as quote currency. For example, if you think that currency A, which is currently $1.50, will increase, you could purchase a call contract for a certain amount of that currency. If its value increases to $1.75, you have made money. Assesses the likelihood of big changes in currency values. The better that a country is doing economically, the more likely that currency will remain stable and increase in value relative to other countries. Factors like interest rates, inflation rates, public debt, and political stability can all affect the value of a currency. Changes in economic factors like a country's consumer price index and purchasing managers index can indicate that a currency's value is about to change. Recognize the risks. Buying and selling foreign currency is a fraught prospect, even for expert investors. Many investors use leverage, the practice of borrowing money, to help them buy more currency. For an example, if you wanted to trade $10,000 of currency, you would most likely borrow at a leverage rate of 200 to 1. You could deposit it as $100 into your margin account. However, if a trade goes sour, you may end up not only losing your own money, but owing your broker a great deal more than you might on your stock or future trades. Additionally, it can be difficult to manage how much currency at a trade at one time and when to do so. Prices of currency rise and fall rapidly, sometimes within hours. For an example, during one 24-hour period in 2011, the US dollar dropped 4% to a record low against the Japanese yen and then rose 7.5%. For this reason, only about 30% of retail trades, the kind of individual currency investors make, are profitable. Set up stop-loss orders. A stop-loss order are a crucial part of currency trading. A stop-loss order will automatically exit a position. For an example, sell off your trade once it hits a certain price. This limits the amount of loss you take if the currency you purchase begins to take a nosedive. For a more practical example, if you're purchasing Japanese yen with the US dollar, and the yen is currently 120 yen, you could set a stop-loss order for a certain price threshold, such as $1 hitting 115 yen. The opposite of this is the take-profit order, which is set up to automatically sell out when you have hit a certain profit. For an example, you could set a take-profit order to automatically cash out when $1 hits 125 Japanese yen. This would guarantee you the profit made from the sale at that point. Record the cost basis for your transactions. In many countries, you will need a record of this information for annual income tax filing. Note the price that you paid for the currency, the price you sold the currency for, the day that you bought the currency. Record the cost basis for your transactions. In many countries, you will need a record of this information for an annual income tax filing. Note the price you paid for the currency, the price you sold the currency for, the day that you bought the currency, and the day that you sold the currency. Most major brokerage firms will send this to you in an annual statement that contains this information in case you didn't collect it yourself. And lastly, limit the amount of currency trading you do. In general, because currency trading is so fraught, experts recommend that you limit the amount of currency trading you do to a small percentage of your overall portfolio. If you do end up on the wrong end of the deal, as 70% of retail currency traders do, Limiting how much you trade and how much your portfolio currency trades represents will help limit the damage.